Hey guys, so my name is Berg. Today we're talking about DEX. I remember when distributed exchange was the next logical step for Bitcoin. We used to dream of peer-to-peer DEX for Bitcoin dollar exchange that is censorship-resistant, trustless, and this was like the end game and utopia for Bitcoiners. We have not given up on this, and for the first time, a theoretical solution to finally creating a decentralized Bitcoin exchange. The problem, though seemingly impossible, because for one, dollars are not digital. Even a bigger problem is the same problem that Satoshi had with Bitcoin, is the Byzantine generals problem. But after seeing Satoshi solve this impossible problem of peer-to-peer cash, years ago, we were all confident that somebody would solve distributed exchange the same way Satoshi did for peer-to-peer cash. So the first question is, what is exchange? So exchange is a central place for buyers and sellers to come to buy and sell. What does an exchange actually provide? An exchange provides two things. One, an exchange provides price discovery. And the second thing an exchange provides is credit risk mitigation. So electronic financial markets use what's called limit order books and centralized matching engines. So why don't we just take this thing that they do on regular exchanges and put it on a blockchain? So let's do that. So we take an order, we say buy 1 Bitcoin USD at $40,000. We create a transaction, we sign it, and we send it to the mempool. So now a miner sees our transaction, and the miner's okay. So this guy wants to buy Bitcoin at $40,000. Somebody else wants to sell Bitcoin at $40,000. Hey, where's Bitcoin today? If Bitcoin's above $40,000, then you know what? I'm just going to buy it myself as the miner. And if Bitcoin's below $40,000, then I'll let him take it. And this is called adverse selection, and it's called adverse selection risk. And in DeFi, this is literally miner extracted value, and in Wall Street, they call it front running. So the ability for somebody else to look at what you're about to do and decide to step in front of you based on external events is what's called adverse selection risk. And turns out you need a central authority to prevent this, and in what they call a central limit order book. In fact, this problem is such a fundamental technical problem that even a centralized exchange needs to run their exchange and matching engine on a single thread on a single server for each trading symbol, because distributed matching engines and limit order books suffer from the same Byzantine generals problem independent of decentralization. Distributing the technology itself is not possible because of the nature. So what's the problem? We just build it on the blockchain. So let's take a look at Robinhood. So Robinhood offers free exchange for no fee exchange. How do they do this? They do this by hiding the fees from retail traders, literally through this adverse selection risk. And they call it pay for order flow. For exchanges to actually really work, it's not enough just to have buyers and sellers. You actually need market makers. And market makers are for-profit traders that are there to make a profit. And they're willing to buy and sell, but they're not interested in going home with the actual product or commodity. In order to attract these market makers, sophisticated market makers are not interested in making markets unless they have the adverse selection risk advantage, or if it's a fair playing field. So that's our utility. So our utility of what we're trying to build is fair price discovery, and front running is our double spend problem. So our core innovation is a distributed matching engine that's front running resistant. Sidepit white paper describes the solution that we're building as a proof of concept. So we're building the proof of concept as a Bitcoin sign, and we're calling it the DEX experiment. So buy Bitcoin at $40,000 with Bitcoin as margin, sell Bitcoin for $50,000, and earn $10,000 in Bitcoin on chain. So on chain with Sidepit matching engine, and there you go. You have a solution to price discovery. Just like Bitcoin needs miners burning energy for double spend prevention, we also need something happening off chain. So why do we need this? So let's look at the CME futures contract. Why does the CME futures contract trade relative to Bitcoin USD on Coinbase? So what's stopping our on-chain exchange from trading at $1 million Bitcoin or trading at $1 Bitcoin? Chicago Mercantile Exchange, they do this by having a settlement tied to a centralized exchange like Coinbase. So they settle for cash. And actually, every single other exchange out there, including decentralized exchanges, including Uniswap, they all ultimately rely on outside price from centralized exchanges. So our solution to doing this is delivery. And this is where you guys come in, the general public comes in. So off-chain delivery of Bitcoin to USD is our external real work action that's needed. Bitcoin solved peer-to-peer electronic cash. We're solving fair price discovery. Bitcoin problem they're trying to solve was double spend. The problem we're trying to solve is front running. Bitcoin uses mining to solve the problem of front running, and we're using delivery to solve our problem of front running. Bitcoin solves double spend. And the delivery aspect is where the technology leaves and like the UASF and the community comes in. And that's what we want to relay in a very simple way is this experiment that people could be part of to, make this reality. And that's the end of the pitch, and we'll open it up for anything from here. So I'll answer any questions or whoever wants to come on stage. I see one of the top developers here, Patrick.
Thank you for the intro. That was really interesting. I must admit, I didn't quite follow the stuff about how the delivery agents take the role of the miners analogously. And also you talked about how there's the UASF aspect to resolving conflict. If you could run over that.
Yeah, so in order to do anything on chain for real, you need knowledge about something happening off chain, on chain. And Bitcoin does this by the nonce, and the mining represents miners mining, right? So we look at the nonce and we say, okay, this means that somebody did some burning of energy. Now, we can't force delivery of the futures contract, but we could assume that people are going to deliver on their own altruistically. So we're saying that if people are going to match and deliver themselves independently, then this comes back to the no arbitrage pricing model of financial marginal assets. So the price of our Bitcoin, BTC USD on-chain futures would be tied to the reality of the price on the ground in some probabilistic way. Otherwise, there's nothing stopping our ticker to hit $1 million and then $1. If it goes up to $1 million and I know I could deliver my Bitcoin for $1 million, I'm going to sell all my Bitcoin because I know the price is only $40,000. If it goes down to $1, I'm going to buy all the contracts because I know I could actually get delivery of Bitcoin. And I can't know this for sure, but I could have a probabilistic knowledge of this. So if there are people, UASF-like people that are saying that we're going to actually take delivery and deliver dollars and accept Bitcoin and deliver Bitcoin and accept dollars based on the results of this exchange, then that's enough to enable us to have actual Bitcoin settlement instead of cash settlement. That's the experiment that we're going to run. Does that make sense?
I'm not sure. I think so. I think I'm just processing what you've said, replaying it in my head, seeing if I get it.
Okay, so I guess a lot of people don't. I have to talk about the Black-Scholes model. Is everyone familiar with the Black-Scholes model? Black-Scholes, I don't know, in the 80s, they won the Nobel Prize for solving options pricing model. And they did this with using the no arbitrage pricing model. And then the futures prices are guaranteed to map to gold futures prices are guaranteed to map to gold cash prices if there's delivery. And that's like a fundamental theory of finance. We're just saying that we're using the same fundamental theory of finance, but we're saying that our delivery is probabilistic instead of guaranteed. That's all we're saying. As a trader, for example, UASF is not guaranteed, but we all assumed it worked. And if there's a probability of delivery instead of a guarantee of delivery, is that enough to have the same result of just keeping our contract in line with reality? That's what we're actually testing.
So in the rogue scenario where someone has entered a deal where they promise to deliver the external asset, dollars or gold, but they don't, then how does the mechanism disguise me or make good my default?
Okay, so 99% of all contracts are never settled, are never delivered. And delivery is voluntary. The only thing that could go wrong is if you say you're going to deliver and you don't deliver, you just settle for cash like everybody else does. As long as there's some delivery happening is what we're saying. We're saying that if the altruistic buyer and altruistic seller and altruistic delivery intermediaries together decide to do this, no one could stop them from doing it. And by them doing that, is that enough for us to do complete end-to-end decentralization? That's what we're going to run this experiment to see if that's enough. So today, when you go to the CME and buy Bitcoin futures, how does that work, right? That works because at the end of the contract, the CME looks at the Coinbase price and says, okay, this is where the contract settles.
CME have committed members with margin and collateral.
Okay, that part. Okay, that part. You're right. I haven't even discussed that part. So that part is already all solved. So we do a. So when you're on. Okay, let's mute someone. I don't know how to mute Patrick. I don't know how to mute individual people, but okay. You sign a transaction using your Bitcoin private key. You sign a transaction to buy BTC USD, but you're not actually BTC USD, but let's just say liquid, right? Or sidechain Bitcoin USD. Okay, so peg Bitcoin USD, and then I sign a transaction to sell, you sign a transaction to buy, and all these transactions go into a block, and the result of these transactions is a P&L. And we leave the UTXO world and we go into the account world. So we're on a blockchain, everybody's running the same code, everybody has the same transactions, and the result of the list of transactions is deterministic. And deterministically, you bought at 40,000, you sold at 50,000, you make 10,000 worth of Bitcoin, and that's automatically given to you at the end of each clearing. And you come in with Bitcoin, you buy, sell, buy, sell, buy, sell in an account-based blockchain, and then at the end of the trading session, everybody gets their P&L in let's say DEX Bitcoin, which is pegged to Bitcoin. So that part is obviously it's sophisticated and complex, but that part's already solved in theory. And the only problem we're trying to solve here is, how do we know that price is real? How do we keep that price real? But everybody else in the world uses Coinbase. We're saying we're not going to use Coinbase. We're saying what's going to happen naturally. Again.
Yeah, thanks. That is a bit clearer. Okay, so pre-funded model, just Uniswap is, or any of those kind of systems.
Yes.
Yeah, I see. So you're solving a slightly different problem. Thank you.
Exactly. And our DEX, although, okay, the word DEX, everybody else takes it to mean, so remember I said there's two types of exchange, there's two reasons for exchange. The second reason is counterparty risk mitigation. So we're not solving for counterparty risk. That's already solved, right? We're solving for price discovery. So the purpose of our exchange is not necessarily, the core of our exchange is not necessarily to actually buy Bitcoin, but it's to speculate or hedge Bitcoin. That's the difference. Like, for example, Robinhood, Coinbase versus Pro, right? Coinbase is for people to buy Bitcoin. Coinbase Pro is for people to trade Bitcoin. So we're like the Coinbase Pro. We're the trading engine for the speculators to buy and sell. And then the entire purpose of a futures market is for that 1% of actual hedgers, someone who actually has a gold mine, right? And wants to hedge his future gold intake by locking in the price today, or wheat farmers, or all that. But 99% of the traders are just degenerate traders buying and selling and market making for alpha. So it's a zero-sum game. The end result is price discovery, and price discovery is a known public good. And CFTC and SEC, they like public goods. So if we could prove that we're making a public good better than what they're doing, high frequency trading, then we could hopefully get away with it, but we're not really asking.